transactions flow through the accounting equation. Assets equal liabilities plus equity. If we were to start off with an individual investing $100,000 into a corporation in return for common stock, that action will do the following. It would increase assets, cash, since the individual is contributing cash to the corporation of $100,000, and it would increase common stock, a form of capital and part of equity, by $100,000. And at the end, we would see that, let me fix this, we would see that assets equals liability plus equity. Now, of course, at this point, liability, we don't have any liabilities. So let's say that this corporation goes out and borrows $50,000 from the bank. So now what happens is that it has an additional $50,000 in cash. But it also has now a liability of $50,000. So now it has total assets in the form of cash of $150,000, liabilities of $50,000, and equity of $100,000. Assets equals liability plus equity. Now let's say that corporation now goes out and purchases equipment for $5,000, paying cash for it. So what's going to happen? Well, one of his assets increased, equipment, $5,000. However, it used cash to pay for that equipment. So that asset, cash, decreased by $5,000. Now let's assume now this company goes out and performs some services and earns revenue. And let's assume in this case that revenue was received in cash. So now it's got even more cash, another $1,000, and it now has revenue, which is a component of retained earnings eventually. Total assets equals total liability plus equity. Moving on, let's assume that to generate these revenue, the company had to pay wages of $200. So now I have to subtract $200 from cash, and I have to subtract $200 from retained earnings in the form of wage expense. Let's assume now that the company goes and purchases fuel, gasoline that it uses, and it pays for it on account. Thus, it's not paying cash, but becomes an accounts payable. Now let's assume the company goes out and earns more revenue. This time it earns $3,000. However, it is not paid that $3,000 immediately. It is on account, and thus it is an accounts receivable, an amount to be received by the company at a later date. So what I did was I increased revenue by $3,000 and I increased accounts receivable by $3,000. Total assets still equals total liabilities plus equity. Now let's assume that that customer now pays part of this $3,000, but instead of paying $3,000, they only paid $300. So the company gets an additional $300, an increase of cash. And the customer no longer owes $3,000 because it's paid $300, and now the net is $2,700. But if you notice, total assets still equals total liability plus equity. Now let's assume that the company incurs more wages, except, well, it didn't pay it. So what happens? Well, now it has a liability. Okay, so what I'm going to do is we have some more wage expense, and this is something that's going to decrease our retained earnings. So let's say it's $500, and now I get wage payable, $500. And really what I did was increase a liability and decrease an equity in the form of retained earnings in the form of an expense. Lastly, let's assume that this company now declares and pays a cash dividend. Pays a cash dividend. So what does that mean? That means it's going to decrease cash by $800, and it's going to decrease retained earnings in the form of dividends by $800. Total assets equals total liability plus equity. This ends our preliminary discussion on transactions running through the accounting equation.